this video, I'm going to show you guys my personal favorite time frames to trade US30. Let me remind you, this might not work for everyone. Everyone is different, but from experience, this works extremely well. And what I want you guys to do is to test this out for a couple weeks. Don't just do it for 1 or 2 days and say, oh my gosh, it doesn't work, you're wrong, Colt. I want you to test it out. And if you guys could, hit that subscribe button if you're new to my channel so you can get more information on how I trade indices and especially my favorite US30. But without further ado, let's get into my computer. Now by this point, you guys should know I only trade the open of the market at 6:30 a.m. PST. What I want you guys to do is figure out what time you trade, because that's one of the most important elements, as I'm going to discuss a little bit furthermore in this video. So I like using the 5-minute and the 15-minute, and one thing that you guys need to understand is when you're looking at the 5-minute at a specific time, you need to look at the minute 15 at that same exact time. Now looking at the minute 15, the candles are going to close at 6:30 on the minute 5 and on the minute 15. So if you look at the minute 5 and you're like, okay, well on the previous candle it was bullish, we're already in an uptrend, it's most likely going to continue up. And on the minute 15 we have a bullish candle and we're already in an uptrend as well. So when we say using 2 time frames in confluence, that's what it means. We're using those 2 time frames together to get an overall bias on what we're going to do. Now step 2, the reason why I use smaller time frames like the minute 5 and the minute 15 is because when we're looking at previous points of support or resistance, the pip count is not going to be as big, versus if we're using the hour 4 or the daily to find previous points of support and resistance where we would put our stop loss, it's going to be a lot bigger, meaning that we're going to have to use a much bigger stop loss when we go into the trade, and most likely a smaller lot size. Now before you go into a trade, you want to already have figured out what lot size you're using, how big your stop loss is, and if it does hit your stop loss, what percentage of your account you're going to be taking as a loss on that trade. You guys need to make sure you understand how to do that. Now step 3, test these time frames out. Don't just test it for a day or 2, test it for at least 1 month. You need to test those time frames. You need to test those time frames on a specific session so you understand when the markets are moving and overall what time works for you best in your day-to-day schedule. Maybe the New York session won't work as good as trading the London session. So figure that out, but overall test it. Now step 4, test that strategy and figure out a strategy that works for you. The most important element when it comes to trading is actually the timing, believe it or not. Now if you're trading when there's no session, the market's most likely going to be consolidating and going sideways, and you want to be in a trade where you see a reaction very quickly. That's why I love trading the open in the market, because within seconds the market starts moving and I can overall see if I'm right or if I'm wrong. Now obviously it's going to take time to do this, but you guys should enjoy the process. Stop rushing and trying to make money, because you're not going to make money. You're just going to lose money if you do not have a strategy that works for you in a specific time that you trade. Now I hope you guys enjoyed this video. I'll see you on the next one. Peace out.